Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to the new business week. It's Monday the 8th of July. This is Peter Lewis with an update of the latest business and finance headlines on Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, job growth in the US was stronger than expected in June, but the unemployment rate unexpectedly increased. The US economy added 206,000 jobs in June, higher than forecasts, but lower than the downwardly revised gain of 218,000 in May, which was cut sharply from the initial estimate of 272,000. Friday's reports from the Bureau of Labour Statistics also showed that the US unemployment rate unexpectedly ticked up to 4.1% from 4%, tied for the highest level since October 2021. The second round of voting in France's parliamentary election concluded Sunday, with the country looking set for a hung parliament with no single party winning a majority in the National Assembly. In a shock result, the new Popular Front, a left-wing alliance formed at the last minute to fight the election, appears to have won the most seats according to exit polls, with 170 to 215 seats. The centrist Renaissance Party of President Emmanuel Macron looks to have come second, winning more seats than Marine Le Pen's far-right National Rally, which came third. China's securities regulator vowed on Friday to clamp down harder on financial fraud, saying it's pushing for harsher punishment against lawbreakers. The China Securities Regulatory Commission, along with 5 other government agencies, jointly published guidelines Friday to combat capital markets cheating. As part of these efforts, the CSRC is revising laws to impose harsher penalties for dishonest disclosures and violations of disclosure rules. Samsung Electronics expects a more than 15-fold increase in second quarter operating profit as memory chip prices continue their recovery from last year's slump, driven by the growing demand for advanced computer chips, particularly those used in artificial intelligence applications. The company estimated on Friday that operating profit jumped 1,452% to $7.5 billion in preliminary numbers for the second quarter. That's the highest since the third quarter of 2022. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and the Shah, Asia Chief Economist at BBVA, and providing a view on Mainland China is writer and broadcaster Mark O'Neill. And don't forget that each weekday morning there is an update of my Asian business newsletter to go with this show. You can find it at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street's Friday, the main US equity gauges closed at record highs for the third consecutive session to notch their biggest weekly gains in just over 2 months. The S&P 500 index advanced 0.5%, closing at 5,567. The Nasdaq Composite gained 0.9% to 18,353, as every Magnificent 7 tech stock except Nvidia finished higher. The Dow added 68 points, or 0.2%, to 39,376 for a weekly gain of 0.7%. The S&P 500 was up 2% over the holiday-shortened week. The tech-heavy Nasdaq gained 3.5%, advancing for the 5th week in a row, and it's now closed higher in 10 out of the past 11 weeks. Treasuries rallied as yields fell in response to the official jobs report that showed signs of a softening US labour market. The yield on the 10-year Treasury note dipped 7 basis points to 4.28%. The 2-year note's yield fell 9 basis points to 4.60%. That's its lowest level since April the 1st. And the US dollar incurred its 7th consecutive day of losses, and at its session lows had wiped out its last 3 weeks of gains. The dollar index fell 0.2% for a weekly decline of 0.9%. The Japanese yen appreciated 0.33%, past 161 per dollar to 160.72 yen, rebounding slightly from 38-year lows and benefiting mainly from a decline in the dollar. The offshore yuan advanced past 7.29 renminbi per dollar, reaching a 1-week high, as yields on Chinese government bonds increased across the curve amid signals from the central bank indicating potential large-scale bond sales. Gold moved closer to its record highs reached in May. Spot gold firmed up 1.5% to $2,390 per ounce on Friday, advancing 2.8% for the week. And Brent crude oil settled 1% lower at $86.54 a barrel. Still, oil posted its fourth consecutive weekly gain, rising about 3%. The price of Bitcoin fell below $54,000 at one point on Friday, the lowest level since February, as traders braced for a flood of sales from defunct Japanese exchange Mt. Gox. The cryptocurrency slipped as much as 8% before recovering over the weekend to $57,440. The move takes Bitcoin's decline from a mid-March peak of around $73,000 to 21%. And shares in Hong Kong ended a 4-day winning streak, with the Hang Seng Index falling 229 points, or 1.3% to close at 17,800. Li Auto dropped 1.9%, while Geely Auto declined 3.1%, XPeng lost 3%, and NIO was down 0.8% as additional duties from the EU, ranging from 20.8 to 37.6%, came into effect on Friday. And for the week, the Hang Seng Index was up 0.5%. The Shanghai Composite declined 0.3% to 2,950, hitting a 5-month low. And futures markets pointing to a decline of about 70 points for the Hang Seng at the open, should start trading around about 17,730. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's the start of a brand new working week. Let's welcome our regular Monday morning commentator, Alex Wong, who's director of Alex K.Y. Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us is Lashar, who is Asia Chief Economist from BBVA. Morning to you, Shark.
Morning, Peter.
Let's start with the non-farm payrolls data out of the US. Job growth in the US was stronger than expected in June, but the unemployment rate unexpectedly increased. The US economy added 206,000 jobs in June. That's higher than forecasts, but lower than the downwardly revised gain of 218,000 in May, which was cut sharply from the initial estimate of 272,000. And economists polled by Reuters had expected non-farm payrolls to have increased by about 190,000 last month. Friday's reports from the Bureau of Labour Statistics also showed that the US unemployment rate unexpectedly ticked up to 4.1% from 4%, tied for the highest level since October 2021. The forecast had been for the jobless rate to hold steady at 4%. And then on wages, average hourly earnings increased 0.3% for the month, following a 0.4% increase in the prior month, and in line with estimates. Over the past 12 months, average hourly earnings have increased by 3.9%. That's the least since June 2021, after a 4% advance in May, also matching market estimates. Alex, let me ask you to kick off with this. Some mixed signals here, I think, isn't there, for the Fed?
Yeah, it is a mixed signal, but I think people will still focus on the inflation data. And I think the job market is not that strong now. Probably we are seeing some slowdown finally. So I think if the inflation data is favorable, then we probably would be waiting for a rate cut soon, probably in September.
Is it still signalling maybe a soft landing, or are there signs that maybe things might be slowing down too quickly?
Well, I think there is a worry probably because household spending probably will slow down quite fairly quickly. But the overall economy is supported by the huge investment in AI right now. Probably we would see those investment focus on several sectors only. So it would be a very polarized performance in economic sectors. So these kind of things is quite difficult to forecast because probably the big companies would benefit from the current situation, but the smaller ones actually would start to suffer.
Okay, and how important is this data for the Fed? Is it going to have to look at this and take it into account, or is it really mainly focused on the inflation data at the moment?
Well, I think they actually need to focus a little bit more on employment because of this. I think may show the situation in the smaller companies. So I think they need to monitor this closely. So right now, I think this is the initial sign. So we probably may not be too early. But if the things turns out worse, especially in the retail, probably we would need the rate cut soon.
Shark, what's your analysis of this data?
Yeah, I broadly agree with Alex on this point. I think if you look at the labor market data, it always provides this mixed picture. That's very interesting. I think maybe they have been distorted by some factor. For example, the immigrants or illegal immigrants factor. Sometimes there have a lot of the part-time ones. So I do believe that this labor market have changed quite a lot compared to the before pandemic period. So that's why at this moment, we always see, on one hand, we see the rise of this payroll figure. At the same time, we see this kind of the unemployment rate rise as well. So it's quite a little bit confusing. But overall, I think that this labor market data is still in line with people's expectation. That means the economy, as you said, is on the way to achieve a soft landing. Okay, although we see a little bit of rise of this unemployment data, but come on, 4%. Okay, around 4% the employment rate. That for United States, that's still very good figure. If they keep this pace, even the figure rise to maybe 5% or even higher in the next couple of years, I do believe the economy still function well. So for United States, because you have a low employment rate, people can have a very good income growth. So the overall economy, even they start to slow down, but the overall figure, I mean, the GDP figures, the inflation figure should be okay. And to come back to its impact on Fed, I think overall, I think now Fed, they put more emphasis on inflation data, PCE data, CPI data, and other related data, maybe wage increase. But for this labor market data, in the past, maybe they think that that's very, very important. But nowadays, I do believe they will just take into account this kind of data, but they don't put overemphasize on this data. They will focus more on inflation data directly. But if you look at the inflation data, I think they start to decelerate. Okay, I do believe they are going to cut interest rate after summer. Yeah.
Right. So you don't think they will cut interest rates?
No, I think they will.
Oh, they
will
will.
cut
Okay.
interest rate. Yeah,
Okay.
they will.
Well, one thing that I find curious, we see this every month recently. We get the number, and then there's this big revision down of that number in the following month. We saw it again, didn't we, for May's figures, which were initially estimating 272,000 jobs and then got cut sharply to 218,000. So I'm wondering how much credence we can put on these numbers when you get such sharp revisions.
Yes, I think that they can keep revising this data. That's exactly what I said, because it seems that the labor market, they are underlying some kind of important change after the pandemic, because of this, as I mentioned, the immigrant factors, the factors of the part-time ones. So that's why they have to keep revising this one. So that's another reason why they shouldn't, why we shouldn't put too much emphasis, because what we look, they are going to revise that in 1 month. Okay, so that's a very interesting development. So that's why I suggest we put more emphasis on the inflation data directly. Yeah. They don't revise that one substantially. Yeah.
Alex, I mean, the other thing that stood out from this, a big surge in government jobs, 70,000 jobs created by the government, and also a lot of part-time workers as well, 50,000 part-time workers. That's not so good for the long term, is it?
Yeah, of course. I think, but that probably would be the structural change. I think for the part-time one. That I think is not a healthy development, but I think that is probably will be a permanent change in the job market. But for the government side, I think Yes, that means the figure is distorted a little bit by the government spending. Yeah.
Okay. Jacques, let's turn our attention to China, because this week is quite a big week, isn't it, for China data? We have got quite a lot of data coming out. We've got loan data coming later this week. Total social financing, new yuan loans, outstanding loan growth coming on Thursday. We've got inflation data on Wednesday. The PBOC has warned already, hasn't it, that we shouldn't expect, or we should expect lower loan growth going forward. It's just not going to be possible to see the sort of data that we've seen in the past. So how important are these numbers going to be?
Yes, in the past, people think this credit data, loan growth data, very important for Chinese economy. But I think this kind of rationale has recently changed, because it seems that the Chinese authority, they want to climb down some kind of financial speculation in the banking system. Because in the past, some banks, they try to boost the data, they try to window dress their credit data. So they do a lot of things. But now the authorities, they try to downplay the importance of this kind of headline figures. They want this bank to provide more quality data to really show how much loans they lend to the real economy, rather than this mutual borrowing, mutual lending between the financial institutions. That's why in April and in May, we have seen a very big decline in this credit data. But seems that the markets buy this kind of idea. They think, okay, it's okay if they honestly, more honestly to report this kind of the credit data rather than do this window dressing things. I think that just for this credit data itself, they didn't cause a lot of the trouble for the market. But I do believe this kind of trend will continue, because we know that when we calculate this kind of data, we always, the growth, we calculate this year-on-year growth. That means this June, July, or even to early next year, the credit data shouldn't be that good. But yes, I agree that this kind of the data is good to have more quality data to reflect the real lending and borrowing situation in the economy. But the problem is this kind of decline. To what extent they reflect the authorities' climb down effort to these financial speculation activities, and to what extent it reflects the economic growth is slowing down. I think that now the market, they didn't put a lot of the emphasis on that one. But I'm afraid at least in part, I think this kind of the decline reflects the slackness in the economy.
So is it going to be difficult, do you think, for China to achieve 5% growth when you've got such a sharp slowdown in loan growth?
I think they could achieve this one by playing some tricks. Because now if you look at the real growth data, now very good. But if you look at the nominal growth, even worse, right? The real data, maybe real growth, they can achieve around 5%. We believe they can achieve 5% in second quarter. We don't know what's going to happen in the second half of the year. This depends how the economy, how the authority will stimulate the economy. But at least now the nominal growth figure is even lower than this real growth figure. So that's not a good sign. That's not a good sign.
Alex, how important is this data going to be for investors this week, particularly given that we got some rather conflicting data from the PMIs, didn't we? The official PMIs and the Caixin PMIs were sort of rather pointing in opposite directions.
I think in the meantime, probably China would have some revival in the manufacturing activities, because the huge investment in AI across the world, and China definitely will also invest a lot, and probably they will benefit those manufacturers. But for the service sectors, I doubt the strength now. I think people would be very worried about the consumption in China right now. So very likely we would have if a diverse view in two sectors. The manufacturing sectors probably would have some revival, but the retail sector probably would suffer. I think that probably would be the case in China. So I think the PPI and CPI probably would be quite important to watch, because probably we may see some pressure in the CPI and some revival in the PPI.
This is sort of the reverse of what we've seen in the first half of the year, isn't it, really, where the services sector had sort of held up and the manufacturing sector was in the doldrums because people didn't want to go out and buy sort of goods. They would rather spend money on services. But you think this is going to sort of reverse in the second half of the year?
Yeah, because we are not talking about the spending on by people. We are talking about the spending by machines right now. So people are investing on the AI theme right now. So that I think will boost China. So we are likely to see a reversal in what happened in the first half. Yeah.
Well, what's interesting is the number of new patents that are coming out from China in the AI space. It suggests that China is sort of, making far greater progress in that space than even the US.
Well, I think there's some tricky part in the patent applications, because when you apply for patent, then probably you have to reveal some secrets. And if people, I don't know whether they need to reveal that much in the US to attract to accelerate the competitions. So I think there's some tricky parts in the AI patent application.
Okay. Shark, of course, the big event coming up is next week, isn't it? The third plenum starts on Monday. What should we be looking out for from that?
Yeah, I think that's a very big event for China. Now, I think there's several things we need to watch on that one. The first one, we need to know that what's their long-term plan. I do believe that now Chinese economy in trouble. Okay, I think they must come up with the long-term plan to overcome the current problems. I think on this one we need to be very careful. Because on the one hand, I do believe that they will make some reforms to make things better. But at the same time, it seems that now they emphasize the idea of this new quality productive force, right? This one, of course, people believe some people believe that's a good thing. That means China will enhance their capability of doing innovation. That's good. But at the same time, some people worry that China, they will implement more industry policy that could make things worse, because now China already have a lot of the trade frictions with the United States, with Europe, with Japan, all these important trade partners. So if China double down on this industrial policy, maybe that we will see more trade conflict between China and the important trade partner. So we don't know, because there's another external impact. Now seems that President Trump have the better chance to come back to White House. So we don't know what's going to happen on Chinese trade with other country. I think this part we must be very careful. Some people said that China, they are going to reform their tax system. I think maybe that's good news, especially for these local government things. Also, people, they want to know why China, they have planned to have this stimulus package very soon. I think that's very important to watch. But personally, on all these economics issues, I'm not very optimistic about this one, because I think that China, they already lay out all these plans. Because over the past 2 years, the economy is not very good. I think that they already lay out what they want to do. So if you expect a big bang impact or big bang strategy, they are going to announce in this third plenum, I think you are going to be disappointed. I think they will put some plans, some very long-term one, some short-term one, but the short-term one was mainly we see the tickering with the economy.
It seems
so this one,
it seems the overall model is not going to change, is it? That is, that there's going to be large amounts of government spending and support for favoured sectors. It just may be that those favoured sectors are different from what we've seen in the past, but the model itself hasn't really changed.
Because this leadership, they have been there for 10 years, right? So they 10 years, if they have some new models, some new ideas, I think they already come up maybe 5 years ago. So you don't expect the same group of people, they suddenly make a very big change to their economic strategies. So that's why we don't believe a big, maybe on good note, you can say that you can expect the continuity of their economic policy. But I don't think they will substantially change their economic model.
Okay, let's turn our attention to the markets. Alex, I want to get your thoughts first of all on what's happened in France, because there's been a bit of a shock there. There was a fear about a week or so ago that the far right RM party, Marine Le Pen's party, could win an outright majority. Instead, it looks like the far left is going to do it. And this new alliance, the New Popular Front, which is a left-wing alliance formed at the last minute to fight the election, appears to have won the most seats, although it doesn't have an absolute majority. So it seems like France has swapped a far-right party for some far-left parties. What does this mean for the markets and maybe particularly the euro?
I think market probably would welcome that, because I think when the far right seems to have the advantage, the market actually was quite worried. So right now, I think the market will stabilize. And also, I think the Airbus situation actually would also help, because in the last 2 weeks, Airbus was under pressure on the supply chain issue, but the company actually is a very healthy situation. I think that also would help the sentiment with big cap stabilizing. So I think people probably would be more comfortable in Europe situation, and the rate cut probably would still be faster in Europe. So I think overall the market probably would be okay in Europe.
Is there going to be a worry about the tax and spending policies of the left-wing parties, if they're the ones that ultimately have their prime minister in place, and that this could breach all the deficit rules that the EU has, and we end up with sort of like a Liz Truss type scenario where the markets get really worried?
I think I'm not too much worried about that. I think that probably we may see the monetary policy to be more favorable. So probably that would be more important. And for the tax side, I think also that probably will be a little bit favorable as well. So I think that should be okay. Of course, I think government finances actually is a global problem. So I don't think market will be too worried about that.
Shark, what are your thoughts on this? Certainly a shock compared to maybe what people were fearing a week or so ago. But as I was asking Alex, I mean, it seems France has swapped the far right for the far left.
Yes, that's a worry. But I think overall, I don't worry too much about the left-wing people. They will spend a lot on their voters. The thing is almost. Most of these left-wing parties, they support EU, they support the big Europe project. So on this sense, I think that they will follow the rule of the EU, because if you support this one, you need to follow their rules. So maybe they can make some change compared to government and Macron. But overall, I don't think they will do too much on this one. But of course, remember, because now even this we can see that the far right group, they didn't win the position. But the thing is, they already showed their power to the government. They already showed their power to French people. So even for this prime minister, the new prime minister, they do their policies. They need to take into consideration these factors, because a large group of French people, they support quite differently. And remember, this Macron, he will continue to be the president. He can do something to reconcile the left and the right. So the overall, I think the result is not that bad. Okay, I think that leaves us kind of the room for Macron to continue his policy.
Okay. Alex, let's look at Chinese stocks and Hong Kong stocks. Chinese stocks came under pressure Friday because of these electric vehicle tariffs that came into force from the EU, ranged up to about 37.6%. It's going to last initially for a maximum of 4 months. Where are we in Hong Kong and China? Because it seems one moment markets are rallying and we might be back in a bull market, then they give up all their gains again the following month. Whereabouts are we in the cycle?
We are in a half bull market and half bear market. I think the bearish side is on the China consumption stocks. So people are super worried about their margins. We have the sell-off in Multi and the sell-off in Longfu. I think that is very worrisome because people think the China situation actually probably would replicate that in Japan. So the price level actually would be very difficult to increase, and competition actually super intense within the retail sector. So I think retail stocks actually is in a big bear market right now. And on the other hand, the SOE actually is in a very strong bull market because Chinese actually pouring money into the treasury in the Chinese bonds. So the yield actually is being depressed, and that is supportive for those SOE paying high dividends. And people are very comfortable in holding them. And also, I think resources stock actually will also benefit because the cost of fund of investment in China actually is decreasing. And resources stocks actually would not have to worry of product price being depressed. So I think resources stock actually is also in the bull market in Hong Kong. So we are in a half bull market and half bear market. For the Hang Seng Index, I think we probably will be dripping lower because the bearish side actually is a little bit bigger than the bullish side.
Okay, I want to get on to our Alex index in just a moment. But before that, let me just ask Shark, what about this plan, these reports that we're hearing, Shark, that the PBOC is borrowing, has put up agreements with main lenders to borrow huge amounts of government bonds to start selling them in the market to try and force bond prices down and yields back up. What do you make of that?
I think that now the PBOC, they want to do this yield curve control, okay? Because they don't feel comfortable with the yield at long tenor. So they want to use this, we can see this kind of the short selling behaviors to make sure the long tenor yield is in line with the level they want to see. First, but it also reflects why this long-term yield is so low. That means people, they don't have confidence. I mean, the firms, they don't have confidence to invest in other short-term or other high-risk project. So they flow to all these treasury bond market. This is kind of another flight to quality things. So now people don't have confidence. They don't want to make a risky investment. So they go to the treasury bond market. Unfortunately, I think that they reflect the dilemma of the Chinese economy. Now you have money, but maybe you have a project as well, but no one wants to take risk. So yeah, that's a big problem.
Do you think it'll work? Because it doesn't change the fundamental problem, really, does it? That first of all, there's a big differential in yields between China and the US, and secondly, economic confidence on the mainland is not that great. So is this going to work, this plan?
I think in terms of this yield curve control, maybe they could work. Because if the central bank, they have a power to soft shell this treasury bond, no one want to play against the central bank because they are so powerful. But in terms of the fixed economic economy, I don't think so. Maybe these institutions, they no longer buy this long-term treasury bond. They will fly to other safer options. Maybe they buy gold, maybe they buy other short-term treasury bonds. So I don't think they can easily fix that one.
Alex, let's finally turn to your index, the Alex Index. This was created back in September 2023. 5 stocks that were going to outperform a bear market: HSBC, China Mobile, CNOOC, China Resources Power, and then more recently added to that, Xi Mining. Performance so far since inception in September 2023, the Alex Index up 38% now. The Hang Seng Index down 1.3% over the same period, so an outperformance of almost 40%. But what's important about this is that it's not just an outperformance, there is a real positive growth in these 5 stocks.
Yeah, that's what I said. I think we have a half bull market in Hong Kong, and so those high yielders actually would be benefiting. So I think that will be continue. I think people would still more comfortable to buy into those high yielders, especially also state money are buying them. Actually, they are buying high yield SOE ETF. So I think that will continue to benefit our index. So very likely, I think it will continue to outperform the HSI, and also very likely to continue to bring some absolute positive gain. Yeah.
And you've got a couple of stocks in it linked to commodities. Obviously, CNOOC linked to the oil price, Xi Mining very much linked to the copper price as well. So what is the outlook for some of these commodities?
I think if Donald Trump get elected, probably we will be more bullish, I think. We probably would continue to benefit from the expectations of a bullish commodity trend. And also, as I've said, the trend in China resources stock actually is more bullish than the international one, because the investment cost actually is decreasing in China. So that makes the investment case even more bullish than the resources stocks in other parts of the world. So I'm quite comfortable in holding them.
Okay, so I was going to say, these have done very well, but you still see good momentum behind them.
Yeah, especially the commodity stocks, the two you mentioned, because they actually would benefit from the bullish trend in commodities. Actually, on Friday we have seen two strong performance in the US. One is the resources, and the other second one is the big caps in tech. So I think that probably continue to benefit, because if you look at the US, actually on Friday we are seeing quite a lot of selling pressure on some sectors like financials and also the small cap space. So that means that people actually are more comfortable in commodities and also in the big cap only.
Okay, well, thank you very much. Have a great week, and talk to you again next Monday. That's Alex Wong, Director of Alex KY Wong Asset Management. Also with us was Lashar, who is the Asia Chief Economist from BBVA.
Peter Lewis's Money Talk.
I'm joined now by China specialist and author Mark O'Neill. Good morning, Mark.
Good morning.
Now, you're just back from Paris, and of course the big news of the day is rather a shock result from the French parliamentary elections. It looks like the electorate have swapped a far-right party for a group of left-wing parties instead. How big a shock is this?
Well, all the polls up till last Friday said that the far-right party, the RN, would be the biggest party in the new legislature. But what happened was the far left parties and the centrist party of Emmanuel Macron, they made an electoral pact. So in most constituencies, one or the other dropped out. So you ended up with just an RN candidate fighting against a non-RN candidate. And thanks to this, the French electorate chose the far left group first, the centrist group second, and the RN third. So that was a big shock.
So this is, is it the lesser of two evils here, or is it that both potentially could have problems, couldn't they? Flirting with the far right, is that any worse than flirting with the far left?
Well, yeah, it is a problem, because now Mr. Macron has to choose a prime minister, and normally you choose a member of the biggest party in the parliament, but there is no party with a majority now. So there'll have to be a coalition government. Now, the far left is a coalition of different groups, very strong individuals in it, lots of disagreements among them over policy. So I'm expecting weeks of wrangling between Macron and the leaders of these different parties to try to find a prime minister they can agree on, and also a program of which they can agree on, because Macron himself disagrees with much of the far left's program.
So to bring this sort of down to a local sort of level, what does this mean for France's relationship with China? We had Emmanuel Macron out in Beijing earlier on in the year. He's met with President Xi Jinping. He's been taking recently rather a hard line against China, hasn't he? So does this change at all?
No, I don't think so, because remember, the trade policy of France is the trade policy of the EU, and that's set in Brussels and not by Macron himself. So I don't expect to be any major changes. Now, remember, France is one of the biggest proponents of these tariffs for electric vehicles because the French automakers are particularly vulnerable. The German automakers, on the other hand, are against the tariffs. So I don't expect any change in that position. Both the far right and the far left in Paris are very protectionist as far as the economy is concerned, protecting French companies. So that line against what they consider unfair competition from China will continue.
I mean, even though the trade policy is set by the European Commission, set at an EU level, presumably they have to take into account the feelings of national governments. And given that France and Germany are the two largest economies in Europe, presumably this does have some impact further down the line.
Oh, yeah. But you see, this decision to implement the tariffs on Chinese EV imports into the EU was taken because of pressure from France, Italy, primarily, and against the opposition of Germany. So you're right. The French voice is important, but it's not the only voice.
And those subsidies, those tariffs have come into effect as of Friday. They're going to be there now for 4 months until they become permanent. What do you think are the chances of China and the EU reaching some sort of agreement, some sort of solution on this?
Well, what the EU would like is for China to produce these cars within the EU. And that means that there would be jobs for Europeans, they would pay taxes to European governments. So that, to me, is the solution to this. Now, we know in Hungary, CATL, which is the biggest maker of lithium batteries for EVs, is building an enormous plant. And they are selling to EV makers across Europe. So what China should offer is BYD, XPeng, and other manufacturers for them to make cars within the EU, and that would be a way to solve this.
And that is very different from the US model, which really just doesn't want Chinese cars at all in the country. It doesn't even want them to invest in the country. But the EU seems to be taking a different approach.
Yeah, I mean, I think the EU approach is much more sensible and much more pragmatic, which is China has this enormous manufacturing capacity. It's very advanced in technology in certain areas. So what the EU is to take advantage of this, whereas the US is just a sweeping blanket ban. And I think that's not good for the US economy nor for US consumers.
Well, but is it what's making this difficult is the EU and China relations are not really on steady ground at the moment, are they? I noticed that over the weekend, the EU ambassador to China, Georges Toledo, he accused China of creating significant challenges for the European Union, enhancing its exchanges with China. He said EU-China ties have become more intense. And he said, I wouldn't say they've improved. They are in a difficult moment. That doesn't sound too hopeful for compromise there, does it?
No, well, the EU is very angry at China's stance over Ukraine because China is a close ally of Russia, is providing Russia with enormous quantities of dual-use materials which the Russian military can use. And diplomatically, it's very much supporting Russia in its invasion of Ukraine. This is a major blockage in relations. Secondly, as we have seen, Chinese agents within Europe and also in the UK have been arrested. The Chinese cyber threat is very real in Europe. And so whilst trade and investment is progressing well, and there are lots of areas for cooperation, in the security and diplomatic area, there are many areas of disagreement. So it's difficult for the European governments to balance these two.
Isn't this the bottom line really now for EU-China relations? We're getting to the point where China can't continue having it both ways, where it chooses this friendship with Russia, which it says is, an almost unbreakable friendship. It's in effect helping finance Moscow's war in Ukraine, but then at the same time want to have a normal relationship with the EU, which says, the Ukraine war is an existential issue for Europe.
Yeah, I mean, you're quite right. It's these two are in mutual conflict, and I myself find it difficult to understand China's position, which is you can trade with Russia, that's fine, treat it like a normal economic partner, like other economic partners. But they've gone much further than that. China is holding military exercises with Russia. Xi Jinping has been to Munich, been to Moscow. Putin has come to Beijing. He's made a very close relationship. And this is completely abhorrent to Europe, because Europe sees Putin as Adolf Hitler. So I think China could do itself a lot of favors if it reduced this closeness to Russia and just treated it as a regular economic partner, and that's all.
Do you think it will do that, though?
No, because it's very evident that Putin is the foreign leader which Xi Jinping likes the most. They've met more than 40 times. You can see the body language between them is very close. So President Xi has evidently made a decision to align very closely with Putin. So there will be no change.
I mean, the reality is really, isn't it, that President Xi, like President Putin, rather likes instability in the West, because they both share the same ambition of disrupting the old world order and creating a new world order, which is formed around their alliance and also alliances with countries in what they call the global South, in other words, emerging market economies.
Well, a friend of mine recently interviewed a senior Chinese official. Sorry, I can't give his name. And he said the outcome that China least wants in Ukraine is a Ukrainian victory or a Russian victory. The outcome China wants in Ukraine is a long war. It'll weaken Russia, it'll weaken the West, it'll weaken NATO, or a peace agreement negotiated by China. Now, this isn't going to happen. So in other words, the outcome China is most likely to get and wants is a prolonged war. Now, for Europe, this is the worst outcome. So you can see how much their ambitions are in conflict.
So it rather makes a nonsense of China's claim that it's neutral in this war.
Well, it's absolutely non-neutral. I mean, I watch some websites about the war, and we see Chinese vehicles, Chinese golf carts in use on the front line by Russian soldiers. Now, these aren't military vehicles. These are just regular trucks and buses, but they're used by China, and they're there on the front line. And we know that many Russian weapons, jets and so on, there are many Chinese components. Now, I've only seen 3 Chinese volunteers in Russian army uniforms serving in Ukraine. I think they're individuals who volunteer. They're not part of the Chinese army. But it's very clear how close China is to the Russian war effort.
Let me just ask you finally about one other election we've had in the past few days in the UK, which has now elected a Labour government, turfed out Rishi Sunak's Conservatives. What sort of impact could that have on relations with China, where, of course, the UK isn't dependent upon the EU?
Well, I think broadly speaking, there won't be any change. I think the UK and the EU have the same approach to China. In security terms, the UK is very close to the US. But I think on trade and investment, the UK will be more flexible, because now the UK is only a small country. It's just 60 million. It doesn't have the strength of the EU market. It needs foreign investment very badly. For example, there is a Chinese company called EV Energy, which is investing £1 billion in an EV battery plant in Coventry. Now, that's the kind of investment Britain desperately needs at the moment. So I do not expect the UK to follow the EU on the tariffs for the imports of EVs, and I expect it on trade and investment issues to be softer than the EU.
Mark, always a pleasure speaking with you. Thank you for joining me this morning.
Thank you, my pleasure. Take care. Bye-bye.
That's Mark O'Neill, China specialist and author.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, chairman of the Asia CEO Forum at IMA Asia, Christopher Lee, partner at Farron Augustine and Alexander Investment, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Woods. See you tomorrow.
Money Talk.